Welcome to Tesla Daily News Podcast. I'm glad you're here. Today is March 28th, 2026, and we're breaking down the Tesla headlines that matter most for the stock: market pressure from the Iran-driven oil shock, fresh labor, and legal noise out of Germany. Key battery supply chain signals tied to Tesla's anode materials, intensifying Robotaxi competition, and what the latest EV pricing trends say about demand and margins. Story 1. Tesla is getting dragged by macro. Oil up, yields up, risk off. Here's the hook. When oil jumps and bond yields spike, high-valuation growth stocks like Tesla usually take the hit first. Context: markets are repricing inflation risk because the Strait of Hormuz disruption is threatening global energy supply. That feeds into higher inflation expectations, higher rates, and lower risk appetite. Details: several market reports in today's batch point to Brent crude back above roughly $110 a barrel, with the U.S. 10-year Treasury yield pushing around the mid-4% range, roughly 4.46 to 4.48%. In the pre-market snapshots cited, Tesla was down around 0.5% to about 1% at different moments, and broader tech weakness pulled the Nasdaq toward correction territory. Impact: for Tesla investors, this matters even if Tesla's fundamentals haven't changed overnight. Higher long-term yields raise the discount rate on future cash flows. That compresses multiples. Meanwhile, higher energy prices can boost consumer interest in EVs, but there's a timing mismatch. The market sells first, and demand benefits show up later. Takeaway: near-term Tesla price action is being driven less by Tesla-specific news and more by oil and yields. If oil stays elevated, watch for analysts to revise rate cut assumptions and for Tesla's multiple to remain under pressure even if unit demand improves. Story 2. Germany labor dispute. Investigators say no evidence supporting Tesla's claim against IG Metall. Hook: Tesla's Berlin story just got noisier, and labor noise can become an execution risk discount. Context: Tesla's only German vehicle plant, in Grunheide near Berlin, has been in a tense environment around works council politics. Investors usually care because disruptions, reputational hits, and expansion delays can weigh on European growth and margins. Details: German reporting cited the Frankfurt Oder public prosecutor after forensic review of a seized laptop. Investigators said they found no indications of recorded or saved audio, and no data suggesting the microphone was turned on at the time. The dispute traces back to a February 10th Works Council meeting and escalated during the Works Council election campaign. The IG Metall union has also moved to challenge the validity of the early March Works Council election and accuses Tesla of influencing the campaign. Impact: the direct financial impact is probably small in the short run, but the strategic impact is real. Berlin expansion plans have already been described as on ice, and Tesla's public messaging has linked expansion difficulty to outside labor influence. Anything that raises perceived labor friction can add uncertainty to ramp stability and future capacity plans in Europe. Takeaway: watch for two things: whether the union challenge triggers court actions that distract management, and whether Tesla signals any renewed timeline for expansion. Berlin capacity and cost efficiency are key for European competitiveness, especially with more aggressive Chinese brands expanding abroad. Story 3. U.S. government takes an equity stake in Syrah resources. Tesla offtake timing is still tied to Vidalia execution. Hook: a battery materials supplier tied to Tesla just got a major U.S. government backstop, but the Tesla contract progress is still not a done deal. Context: Tesla's battery cost curve and supply security depend not just on lithium, but also graphite. Graphite is essential for battery anodes. The U.S. wants to reduce reliance on China, which dominates both mined graphite and battery-grade processing. Details: the U.S. International Development Finance Corporation plans to convert a $31 million loan into equity in Syrah Resources, taking roughly a 20% stake. DFC is also providing an additional $15 million to Syrah's Balama mine subsidiary. Syrah owns the Vidalia active anode material facility in Louisiana. Crucially for Tesla, the report notes that delays at the Vidalia facility have slowed progress on a long-anticipated offtake agreement with Tesla. Impact: for Tesla investors, this is a two-sided signal. First, bullish. It shows Washington is willing to use direct capital to stabilize critical mineral supply chains, which could eventually support localized battery material sourcing and reduce geopolitical risk. Second, cautionary. If Vidalia has been delayed long enough to push out a Tesla offtake, that's a reminder that building battery-grade processing at scale is hard, and timelines slip. Takeaway: if you're tracking Tesla's margin story, keep an eye on US-based anode processing. A successful Vidalia ramp could help long-term cost and supply resilience, but the near-term headline is still execution risk. Story 4. Used EVs are rising fast, incentives are heavy, and that's the real read-through for Tesla pricing power. Hook. EV buyers didn't disappear. They went bargain hunting. Context. Tesla's investment case relies on volume growth and software and services upside, but automotive gross margin still matters a lot. When incentives rise across the industry and used EV supply reshapes the market, new vehicle pricing power weakens. Details from the U.S. market snapshot cited, average price of a new EV was around $55,300, with incentives exceeding about 14% of transaction value. Average discounts were cited near $7,900 per vehicle. The same report says used EV sales jumped by nearly 29% year-over-year to about 31,000 units, with average used EV prices falling below $35,000. It also notes Tesla remains the leader in sales, cited around 38,500 vehicles in that dataset, but with share gradually declining as competition increases. Impact. If consumers can buy a used EV for under $35,000, sometimes cheaper than comparable gasoline cars, that competes directly against new entry trims, including Tesla's lower-priced offerings. For Tesla, this can pressure ASPs, and if Tesla chooses to defend volume by a price, margins can compress. Takeaway. As we approach quarterly delivery season, a key investor question is not only how many units, but at what price and with what incentive load. Watch for Tesla's inventory moves, financing promos, and any sign that used EV prices are pulling down new EV transaction prices. Story 5. Robotaxi momentum is shifting, Waymo is scaling quickly, and it raises the bar for Tesla's autonomy narrative. Hook. Waymo says it's now doing about 500,000 paid Robotaxi rides per week, and that's real-world scale. Context. Tesla's valuation has long carried an autonomy and Robotaxi option value. Investors will compare Tesla's rollout speed, safety record, and regulator relationships to the competition. Details. Tech reporting says Waymo's weekly paid Robotaxi trips grew from about 50,000 in May 2024 to about 500,000 per week now, a tenfold rise in under 2 years across 10 U.S. cities. The same piece references a fleet figure of over 3,000 vehicles equipped with its fifth-generation self-driving system, based on filings to U.S. safety regulators. Impact. This matters because Robotaxi is not just a product, it's an operational business with utilization, dispatching, edge case handling, and incident management. Waymo's growth suggests it's getting better at utilization and expanding markets faster than many expected. That can influence analyst sentiment about who wins autonomy revenue first. Takeaway. For Tesla watchers, the actionable angle is timing. If Tesla can expand its Robotaxi service to multiple cities and demonstrate consistent safety and uptime, the autonomy premium can reinflate. If not, investors may assign more of the Robotaxi market to competitors and demand more proof before paying up for Tesla's autonomy story. Story 6. Tesla in the consumer EV conversation. Model 3 and Model Y remain anchors, but the market is increasingly price-sensitive. Hook. Even as gas prices rise, the EV battlefield is shifting toward affordability and charging convenience. Context. Higher gasoline prices can stimulate EV demand, but buyers compare total cost, purchase price, incentives, charging access, and depreciation. Details. One roundup of 2026 EV picks highlights Tesla Model 3 starting around the high $30,000 range, with long-range versions cited up to the mid-300-mile range. It also reinforces Tesla's advantage, supercharger network access, and over-the-air updates. The Model Y is framed as a continued top household choice thanks to its crossover utility and Tesla ecosystem. Impact. The supportive signal is that Tesla remains a benchmark for range, software, and charging. The less supportive signal is the growing list of credible alternatives around the mid-$30,000 price point, like the Chevrolet Equinox EV in that list, which intensifies competition in the highest volume segments. Takeaway. Tesla's edge increasingly comes down to manufacturing cost, software attach rate, and charging ecosystem, not just being an EV. Investors should track whether Tesla can keep costs falling faster than competitors as incentives normalize over time. Before we close, one quick thread that links today's stories. Macro pressure is dominating the tape, but beneath it, Tesla's next valuation leg still depends on execution, autonomy rollout, manufacturing efficiency, and supply chain de-risking. That's it for today's Tesla Daily News podcast for March 28, 2026. Tomorrow, watch for more delivery and pricing signals heading into quarter end, any new details on Robotaxi expansion timelines, and continued market sensitivity to oil, bond yields, and Middle East headlines. If you found this helpful, subscribe so you don't miss the daily roundup, and follow our feed for the next episode.